So you've been asking and asking and asking, and today, finally, I'm going to talk a bit about it. Building a uranium portfolio, strategies, ideas, problems, how I think about it, how you might want to think about it, and what are a few types of examples that we might look at. So I want to start with the regular disclaimer. What you hear on this video ranges from not investment advice to very not investment advice. This is because everyone has their own risk tolerance, hopes, targets, views, what have you, and really it's too soon to know what is going to happen in the cycle. And so this is just going to look at a few ideas, and I own some of the stocks that I will talk about today, not all of them, and there are others that are not here that I do own, but I don't feel necessarily like they belong in this type of conversation. And remember, I mean, I want to stress this so much, especially after having been here for a while. None of these are close to perfect. All of the stocks here, many of them I would go with tolerate rather than like, so be cautious. So there is a bit more preamble that I wanted to get through before I went to the meat of the video, but if you can get through this, you'll probably won't be too upset with what I talk about later. Number of examples. But to start with, for a long time, I didn't really want to make this video. I didn't really want to talk about this because I don't consider myself to be an expert, a global authority on uranium. There are some out there, and then there are others out there that many people may consider to be an authority, and really if you look at what some people have said and done and say they've said and done, it makes it look like either they're not being completely honest, they got some sweetheart deal, or they are very much not an authority on uranium and are just authority on promotion. But there are some great people out there, no doubt. I'm just giving my opinion. Again, I'm not the global expert. I'm just someone who's done some reading, done some looking, and has an opinion. And again, another reason I didn't want to do this video, there's so many unknowns. It's too early to say bad or good. And every day it seems that there's something in this sector, something happens, some whatever, some insider sale, some grant of the in the money options, some upsizing on a financing below the market, extending warrants, bloated salaries, whatever, that make it really hard to like many of these companies as investments or to say good about many things. So I'm aware of this, and I didn't really want to say, oh, I think this company belongs in a portfolio only for them to do what they do. But what's been bugging me more recently is that perhaps all these reasons, perhaps all these risks are why maybe I should talk about some of the stuff in this video. Because there are some big risks out there. There's dilution, and in almost all of these companies, to some degree of dilution is inevitable. But how it's done, how it gets factored in is an entirely different question. What price, how much is needed, etc., etc. Then there's risks like location. In many ways, location can be a risk, as can construction, budgeting, market, price. There's so many different risks that can factor into different decisions that it can be important to look at some of them and diversify in certain ways, and that is kind of why a portfolio may work and what I will look at today. But because of all these risks, it can be useful to have a portfolio. And so the thing is, having a portfolio doesn't necessarily help if all of the stocks you pick have the same risk. Because let's say you choose a wide portfolio of all of these stocks that have high cost, very high burn. Well, that doesn't necessarily help. because you're not getting rid of your risk. So that's why today I'm going to look at within the consideration of what's the risk. Do I have too much in this country? Maybe. Okay, so let's not have too much there. Do I have too much high cost, too much low cost? I mean, too much low cost might not be a problem, but maybe you can get some more leverage in some other places if there was a spot in your portfolio for it. Do you have everything that's just 3 decades away from mining, and so the price doesn't really necessarily matter? No, that's another risk. And burning, or do you have only stocks that if you're too early, it means wrong? That's another risk. So there are ways of hedging these risks, but diversification can be one of those ways. So that's something to consider when building a portfolio. So one question I feel like I've gotten a few times at least is how many stocks should be or do you need in a uranium portfolio? And this is highly subjective, and this is not coming from a place of professional finance portfolio theory. This is coming from looking at the uranium companies and looking at thinking about what the risks are. I would say 5. Obviously, if you're going to go with only high risk companies, then you probably want more. But if you're only going to go with low risk companies, then 5 is probably well more than you need. Again, also, if it's a huge portfolio, like if it's a substantial amount of money for you, then you might want more. Or if it's a very small position or a small percentage of your portfolio, you may only want like 3. 3's fine. And I'll get to a 3-stock portfolio in a sec. But the point is, it depends on the person. But really, for your average person, average portfolio, I would say 5 seems like a good number to me. So I do want to point out that in this case, there's nothing wrong with either starting with or using the URNM ETF. It is 50% large juniors and 50% approximately majors and physical funds. So just be cognizant of that. But there is, it's a fine ETF. It's 100% uranium in all its forms. So if people wanted to use that, it's sure you're going to have some stuff that maybe you personally wouldn't buy individually, but it's not the worst place to start. Also, though, I do want to point out that Mike Alkin is involved with the macro advising for the fund. He's not making the pick. So I just want people to be aware of that, that he is not saying include this, avoid that. He's just advising on the macro, because I do see a bit of misconception on that sometimes. The last comment I wanted to quickly make before getting into the first of the model portfolios is this is for the uranium segment of your portfolio, obviously not the whole portfolio. Now, I no matter how much conviction I have or anyone else has, I wouldn't recommend going all in on one idea. Now, that isn't to say if you're new to investing or only have a little bit of money to invest for your risk portfolio that if you're in one of those cases, then it's not necessarily a problem to go all in on one idea because, you'll probably be adding to that over time and it's not so much of a what you have situation. So I mentioned a few seconds ago that I would talk about a 3-stock portfolio that was really all you need. And if I were going to make that portfolio, it would be Cameco, Uranium Participation Corp, and Global Atomic. Now, why these 3 companies? There's a very specific reason. These are the 3 companies that I think are best suited to adding value until the price moves. So let's say the price takes a long time to move. Let's say it's flat for 3 years, let's call it. Well, Cameco is buying some of their needs on the spot market and selling higher into contracts. So they're adding value without depleting the asset there. So that's better if the price goes lower. Same thing. So if the price goes to $20, great. They buy it cheaper. Uranium Participation Corp. Well, currently they trade at a 18% discount to their NAV, so they can add value there. Global Atomic, well, they have their zinc operation, so they can be profitable waiting for the price to move, and the uranium price, until it matters, doesn't matter for them. So there's that. Now, normally, the defensive side of the portfolio might be an interesting spot to put a royalty company. In this case, however, for a few reasons, I wouldn't. And the main reason that I'll discuss, and there are some other ones, but the main reason is that in this case, the royalty company is not cash flowing. They are just like the juniors in that they don't have a revenue stream coming in. They are just have the expenses of running a company going out. Now, I don't want to get too much into this, but that's why I don't have it here, and that's why I think that the Uranium Participation Corp, or Yellow Cake, could work too, is a great value add when you're trading at, as it is now, a 20% discount to its net asset value, because the discount, the difference, allows them to add value, which is one of a very small number of lower risk ways to add value these days. Now, I didn't mention sizing just before, and that's because in that case, in that 3-stock portfolio, the minimalist, if you will, really the amount of leverage and the amount of risk that you wanted could be tailored by adjusting how much of each one you wanted. So, if you wanted a lot of risk and a lot of more reward potential, then higher towards the junior side, which was Global Atomic in that case. If you wanted very defensive, higher towards the Uranium Participation Corp side. And if you wanted more in the middle, well, Cameco. Now, that said, all of those three are very, very defensive compared to many of the other picks, which I'll get to in a second. So when we're talking sizing, you could split it evenly. Personally, though, that's not how I'd go about it. For me, it's a bit more nuanced because I do recommend building positions over time, which means that sometimes some might fall more and be a bigger bargain. Other times it works a bit differently. So I would also want to have more in my favorites, and I do have more in my favorites versus other things. So there's some larger positions that are higher percentage of my portfolio because I think of them as maybe have an equivalent amount of upside, maybe more upside. But more importantly, when I'm sizing a position bigger, I want something that I think has less risk of permanent downside. And so that is something to think about. And so the quality section of a portfolio, so there's the favorites, then there's the quality, and then smaller at the end, at the more speculative positions. Maybe there's something I really like, but it's really risky. Well, that I might have smaller. So for example, if I wanted to have a portfolio of 5 stocks, I might go 35%, 25%, 13, 13, 13. For example, if there was one I really liked, but if it was more neutral, you can have it more neutral. Again, all of this is personal preference. Versus an 8-stock portfolio, maybe 35 favorite, 15, 15, 2 really good ones, 10, 10, 10, 3 that I like, they're good, and then 7.5, 7.5, 2 more speculative ones. Maybe, I don't know. This is just thinking out loud, things to consider. No rules. If there's a rule, then it's a science, and if it's a science, then it's less fun, really, and less thought needed to weigh the different possibilities. Now, I did point this out before, and I do want to reiterate, if there's one that was my absolute favorite, however, I didn't think of it as necessarily less risky in that it's my favorite because there's so much more potential upside, but there is still a ton of risk, well, then I might skew it down. I wouldn't have it that heavily weighted at the top, but again, personal preference. But let's say we're making a 5 stock portfolio. Well, what would that look like? So that I would say this is a more balanced 5 stock portfolio in that I'd have maybe Boss Resources, Global Atomic. There we have Australia, Niger, and then we have either Paladin or Bannerman. Now, both of these I like, both of these I own personally, but as for a spot in the portfolio, it depends on what you like because actually, in this case, time-wise, Paladin probably has more risk than the junior in that if it doesn't move in the time. But in the development side, Bannerman has more risk than Paladin because Paladin has a producing mine. So there's which one of you prefer, but both could fit in that slot there in terms of Namibian, very close to production slash it's formerly in production, and both could, um, higher cost, well, ish. Uh, Retract that because there's going to be too much debate there. Cameco, if you want a company that's in production, my pick for a portfolio, for a small portfolio at least, would probably be Cameco. And then let's say you wanted another smaller producer, slightly more speculative. Well, I would go with either Lotus or Encore. Now, both have their people that like them and people that don't like them, none more than Encore. I know it's very debated. I'm aware of why. I know what's going on there, but I think it definitely with their permanent assets, has a spot, maybe as a speculative position in some portfolios. I mean, again, I'm not telling people what's right and what's wrong. I'm saying there's something to look at. So here's just as an example, let's say we're going with that 5 stock portfolio. Let's say that was our gold standard, what we wanted to do. How would the weightings look? Well, I don't know. If I were doing the weightings, as I said, my favorite might just pick one. It's Global Atomic. Then let's say we wanted to go a bit more defensive with the rest. For example, let's go with Bannerman because less burn than Paladin. Well, it's not really so much the burn as the big debt maturity, but I think Paladin will be fine. Just for the record, I'm just saying in this case, we're being defensive, and I'm saying that because you look at Cameco, for example, we're giving that a bigger weighting versus one of the juniors. All 3 juniors are fine. Again, good. We're giving them 13 and a third each for Boss with the restart, Bannerman with a bit more leverage there, and Encore, which is a bit of a mix really between a restart and a exploration. And I don't know how to qualify it, but let's say that's what a 5 stock portfolio might look like. Because again, if all you want in your portfolio is various degrees of direct leverage to the spot price, you don't want development, too much development, you want the spot price goes up, these companies are worth more money, make more money, whatever you want to phrase it, then, I mean, there's some very simple ways to play it. There's, again, Uranium Participation Corp, Boss, again, shut down an existing mine. There's some restarting there, not that high cost. And then there's Paladin, if again for the more leverage to existing operations. And then there's Kazatomprom. Nothing wrong there. Kazatomprom, the costs are probably a bit higher than what many people are thinking or saying, but that doesn't mean that if the spot price goes up, if you go from break even / slight profit to a lot of profit, it's direct leverage, and there could be a lot of upside potential there. And that's a fine way of putting it if you just wanted to have not too complicated, not too deep in the weeds juniors, and just spot price up, portfolio up. Another question I get sometimes is, if you could just buy one uranium stock, what would it be? And I think I've said this probably a number of times, but for me, it would be Global Atomic. Now, why is this? It has a lot of more resiliency than many of its peers, especially in the juniors. Resiliency in terms of not necessarily needing so much more capital, needing to dilute a big percentage in terms of going forward. It has, well, defensiveness in that regard. It also is a very large discount to its net asset value, something that is very important to look at, discount to net present value. Producible near term, economics of the project look quite good. Again, everything's subjective, not for everyone, but if you look at peers, it's definitely, in my opinion, one to look closely at, if not own. So now that we've covered the defensive and direct and not fancy portfolio, let's get to the definitely not investment advice portfolio. Because in uranium, as in many things, there's a lot of different ways in which you can be aggressive in a portfolio. Depending on how you think things will play out, you can have different picks and have different ways of playing that, where if you're right in how to be aggressive, you'll make more money. And so I just decided to go through a number of, again, always opinions here on how I would play different things, different ways to be aggressive. Well, if you were thinking that time and that price is going to move soon, well, the aggressive way you might want to play it is have either some paladin or some more paladin. If you think the price is going very, very, very high, well, there's probably some of the most leverage, most direct leverage to price in terms of net present value. Well, that would be in Bannerman. Global Atomic, it's not specifically aggressive, and I mean, I guess it's aggressive. Some people might not like the location, but in terms of risk, I don't really think of it as one of the more aggressive plays. In terms of reward, it may be one of the more aggressive direct plays, at least. So that's an option. What if you're looking for a management unknown that becomes a management known? I mean, well, if Forces finds management and figures out its own identity again, there's some potential there at least. But for now, who knows? If you think that if you want to bet on management executing on a plan and putting things together and executing on a plan, really, you might want to look at Encore. They're looking at M&A, consolidating the U.S., ISR. They have some decent assets, and they're permitted now. Who knows? If you are, this is a tricky one. I like Vimy. If you think they can be patient and not snap at their first opportunity to go into production, I think Vimy will do better in that case. If you're thinking that permitting is going to be quicker than it has historically been, you might want to look at something in Canada, maybe Denison or NextGen. Versus if you think that if you think there's going to be social acceptance for uranium mining, I suppose I could put Berkeley in here too, but if you think that there's going to be social acceptance and change in politics and stuff like that, then there's some very big discounts in something like Laramide or Plateau. So I don't know how people want to be aggressive, but if you wanted a more aggressive take in your portfolio, these are some names that I might consider looking at. Now, I do think it's important to reiterate that when you're looking at surviving until the price moves, let's say you think it's a when, not an if, okay? How do I get to when? Well, be alive, survive. And how you do that is you need to make sure that the company, A, doesn't have any big pitfalls in the time that it takes, and B, make sure that the company won't burn too much value away, either by G&A or other expenses that the company has to do, whether they spend tons of money paying management, marketing, drilling, whatever. Look at how much they burn per year as a percentage of the company. Remember, this can change because the company could get smaller or bigger. How much do they burn? Because it's not always the juniors, oh, this is a tiny company, big deposit, maybe someday. It's not always them that burns the most money, because there are some companies that maybe are in other situations that go through a lot of money waiting, same as juniors, and maybe even have less upside. So be sure to look at how much money's burnt, what percentage of the company will be lost if nothing happens. And again, this applies at all stages: exploration, development, idled production, producing even. So just be careful and focus on that in terms of looking at how to make it to when the price moves. Now, I do feel it is necessary to mention, because it's very relevant, that this is just examples of a target portfolio with today as maybe a starting point. Going forward, if I were starting to build a portfolio, because things change a lot, and something random happens or some price falls a lot, and all of a sudden a company that was just okay is great. I mean, this happened for me for Paladin. I didn't really see the point 2 years ago. I didn't really like it given a whole bunch of things, and then things shifted and the price fell a lot, and then I really liked it. And so, you can have a plan, but things change, facts change, and the markets change. So you have to be ready to adapt. And I will say personally, I had a plan for my portfolio, scaling in, really would recommend. But the portfolio doesn't necessarily look like I had planned, because the market's different and the portfolio is different. There's more positions. There's probably going to end up being more positions than you may plan for. It may end up taking longer than you plan for also. That surviving that is, well, key to surviving. So you will have noticed probably that I didn't cover any real pure play exploration companies here. And that is because I tend to not want to have too much exposure to them, because there's a lot of risks and a lot of questions that need to be answered. How much uranium do they have? Can it be mineable? How, when, whatever. And there's a lot of cases like that, cases of unknowns, that it's just, I don't necessarily feel comfortable talking about different things. So the more questionable the timeline, the whole bunch of things are, the less I want to talk about it or put it in a portfolio. The other thing is, I don't want to go too deep into why not XYZ. I don't really want to go there. I've spoken about many names recently. I keep getting questions, well, why not? Deep Yellow is the current one. I have my thoughts. Not for me. There's companies out there that are not for me, maybe for someone else. I have my reasons. Some of them I have what I feel like are strong reasons. Other times I don't really love the price reason, or just some other thing reasons. But yeah, that's basically what I wanted to say. If something's not on the list, well, it could be fine or could require more of a look. Now, I do want to say that there are a whole bunch of okay companies out there. There's a number that, many of the ones on the more aggressive list are ones that I deem are okay. Maybe have some potential, maybe some people love them, but many of them that weren't in the regular 5-stock portfolio are okay, could go in someone's portfolio if they like some aspect of them. And then there's some other ones that weren't on the list that are fine, okay. Maybe I just don't, can't get past, I don't know, some thing that the CEO is insistent on that I don't necessarily agree with and think that is probably the wrong decision, or if the financings over time has been too harsh on the share structure, something that I just don't have it on my close list. And, other times there are companies, I'm not saying that all companies that aren't here are okay, because some I don't want to get into, but are not okay. With me at least. I mean, some of the things that they do with, options, warrants, are just very questionable. And so again, on this list, off this list, ones I talk about, ones I don't talk about, you really need to look at them for yourself, look at what they've done, what they say they're doing, and does it match up, and does it make sense? Is it right for you? So anyway, that is just about all I wanted to discuss for today. Thanks everyone for watching. I hope this is enough to think about for one day. Ran a bit longer than I expected. But I hope this helps. I hope this helps, even if you rightfully ignore every single thing I say and whatever. I hope just helps you think about building your own portfolio and what risks you are prepared to take and want to take more of. With that, I wish you the best, and until next time, have a great day.